What's up guys, hope everyone is doing well. In this video I'm going to be going over some updates for the stock market, where I think it's going to be going in the near future, generally just within this decade, which really just is continuing to elaborate on what I started saying around 2 years ago, specifically with October of 2022, pointing out how through the data, not only in the charts but other economic data, it appears that there is some sort of significant financial, in terms of the traditional stock market, significant crash on the horizon in the near future. But before I get into going back over that, going over this chart once more and showing a few things that pertain to what I specifically see, I want to play two videos I came across recently that have some very, very eye-opening and interesting information and data to go over concerning the SPX, the stock market in general, and everything related to that. It's only going to be about 15 minutes, each two videos about 8 and 6 minutes long, but nonetheless, here are these videos.
In November of 1928, Herbert Hoover was elected as President of the United States. This election happened during one of the strongest US stock market rallies in history, following a complete decade of very strong stock market performance, leading to one of the most expensive stock markets in history. This euphoria continued for a few months after the election, but was ultimately followed by Black Tuesday, and then the Great Depression led to the stock market declining for almost a full decade. Fast forward to November of 1972, President Nixon was elected right before the S&P 500 made a peak that wouldn't be revisited for 8 years. Fast forward to November of 2000, President Bush was elected, this time marking almost the exact peak of the dot-com bubble, once again ending a 10-year-long streak of rising stocks and followed by a 10-year downward streak. These 3 years, 1928, 1972, 2000, all marked absolutely massive turning points for financial markets, ending extended periods of prosperity and marking the beginning of painful declines. And all three of these turning points were accompanied by major US elections. Of course, there are many examples of elections that did not lead to these kinds of market crashes or extreme recessions, but heading into the 2024 elections, the stock market has been experiencing one of the strongest rallies in history, and economic growth was at the forefront of the debate, because despite an extremely strong stock market, most people in the United States aren't very happy about the state of the economy. US consumer sentiment is at one of the most depressed levels since the Great Financial Crisis. This is a survey that's done by the University of Michigan that has been measuring how people feel about the future of the economy going back to the 1950s. And all of the moments where consumer sentiment has been at similar levels to today have been associated with economic recessions in the United States, as indicated by these gray bars. Consumer sentiment has been around these levels since 2020, so basically the entire duration of the current administration. Perhaps one of the key reasons for why Trump was able to win the presidency, as many of his policies were centered around the promise of stronger economic growth. In fact, as we discussed in the last video, the US stock market has reacted very favorably to the news of Trump's victory. The promise of further tax cuts on US corporations and deregulation are both boosting investor optimism. But we had very similar kind of optimism heading into the 1928, 1972, and 2000 elections. In fact, we have quite a few key similarities between these episodes and today. For example, interest rates in the United States in those 3 episodes were in a very similar posture to today. In all 4 of these cases, the Federal Reserve, the US central bank, raised their interest rate to about 5%. And in all 4 cases, we see that the interest rate dictated by the Federal Reserve was higher than longer-term interest rates. Now, that may sound a little bit complicated, but you've probably heard of something called inverted yield curve. And that's exactly what happens when this line is above this one. As you can see from this chart, it doesn't happen very often, but when it does, it has huge implications for the economy looking forward, and it tends to be followed by an economic recession. So in all 3 of these episodes, the seeds for a recession were sown long before the actual election results. So the elected president really couldn't do much to save the economy. Now, Donald Trump himself has repeatedly said that the US economy could go into another Great Depression if he wasn't elected.
toward a Great Depression. You're going to have a depression.
His main argument is that his economic policies are generally more favorable to the economy. Things like tax cuts and deregulation are indeed things that can stimulate economic growth. So can Trump's favorable policies really avoid a large economic downturn? Well, let's rewind to the US elections that occurred right before the Great Depression in November of 1928. Right here, Herbert Hoover supported the Revenue Act of 1928, which effectively reduced taxes. Herbert Hoover was also a pro-business Republican and pro-private sector growth. This is probably an oversimplification of things, but when it comes to the political spectrum, we can say that Herbert Hoover was a lot closer to Trump than he was to Kamala Harris. Now, the stock market soared into this election, excited by these tax cuts and deregulations, and they soared for almost another year following that. But it did not stop the most severe downturn in history from occurring. The exact same thing can be said about George W. Bush in November of 2000 and about Nixon in 1972. Both favored lowering taxes and a free market economy. Both were not able to stop a recession from occurring shortly after. So in conclusion, in the grand scheme of things, presidents can't do much to change the course of the business cycle and financial markets. Their policies can definitely prolong or shorten economic booms or recessions with favorable or unfavorable policies, but they can't outright prevent a recession from happening. So is Trump's 2024 presidential win a sell the news event, just like all of these major US elections were? Well, as we just saw in 1928, the stock market was optimistic heading into the election, but stocks continued to rise for another year following the election. In 1972, the stock market continued to rise for another 3 months before it peaked. Today's stocks are experiencing the ideal market environment to thrive. Economic growth has been stable, inflation has been low, and the US central bank has been lowering interest rates. We've only had this specific type of environment a handful of times throughout history. All of them are highlighted right here. It seems likely that this environment can last another few months. When we zoom in on the technical chart of the S&P 500 today, we're seeing the index attempting to break out above a key trendline resistance. If this breakout holds, it opens the door up for a move to 6,500 points by the end of the year. Now, we use this recent correction to load up on quite a few different trades on stocks and cryptocurrencies that were trading at a discount just a couple of weeks ago before the election. You can access all of our trades, buy and sell alerts, the entire strategy that we have on the stock market, cryptocurrencies, commodity markets by signing up to our website at bravosresearch.com. Warren Buffett's cash pile just hit another all-time high, reaching a record $325 billion. So today, Berkshire Hathaway, Warren Buffett's holding company, is storing $325 billion worth of cash on the sidelines for a company whose sole purpose is to be allocating capital to stocks. This is a concerningly high allocation to cash, and many interpret this as Warren Buffett's way of preparing for a significant market decline, that somehow Warren Buffett is aware of a large economic downturn that's on the horizon and that he's hoarding as much cash as possible in preparation for it. Don't miss our Cyber Monday discount, by the way. There's only a few hours left to take advantage of it. The next time we're doing a discount like this will be a year from now. You can access our entire strategy along with all of the buy and sell alerts we send out to our clients. You can see all of our closed trades on our homepage. If you're interested, don't miss this deal. Over the last 30 years, Berkshire Hathaway has returned about 2,100%, while the S&P 500 index has only returned about 800%. So Warren Buffett's investment decisions have enabled him to outperform the S&P 500 on a consistent basis over the last 3 decades, something that 85% of professional money managers are not able to do. So yes, Warren Buffett's decisions are definitely worth paying attention to. But Berkshire Hathaway's cash pile has been growing consistently over the years. Since 2012, his total cash pile has consistently been making new all-time highs almost every single quarter since. There was a brief exception in 2022 when Warren Buffett reinvested part of his holdings into the stock market, but since then he's been resuming his ramp up in cash allocation. Now, part of the reason for this is that Berkshire Hathaway is not at all the same size it was 20 20 years ago. In 1997, Berkshire Hathaway's total market capitalization was $50 billion. Today, its market cap is $1 trillion. So we can't just look at the total cash allocation to understand what Warren Buffett is doing. We need to look at his cash allocation relative to the size of all of Berkshire Hathaway's holdings in percentage terms. And today that cash allocation stands at about 30%. Berkshire Hathaway's total cash holdings represent about 30% of its total portfolio. And we can see how his cash allocation has evolved over time. Going back to the 1990s, Berkshire Hathaway has indeed never held this much cash relative to the value of their total assets. So in other words, we've never seen Warren Buffett be invested in the stock market to such a small extent as today, which effectively doesn't suggest he believes the stock market looks particularly attractive today. But does this mean that he is preparing for some kind of black swan event, or that he has some foresight into the next recession? Well, the last time that Warren Buffett had a particularly elevated allocation to cash was between 2004 and 2007, a 3-year period where his cash allocation stayed quite consistently above 20%. Soon after, the 2008 financial crisis occurred, and that's the moment where Warren Buffett finally began to reduce his allocation to cash again and reinvested his holdings into stocks once the crisis had passed. Many people point to this episode as a sign that Warren Buffett knew something that others didn't about the US economy. But when we look at this episode more closely, we see that it's very unlikely this was the case. His maximum cash allocation was reached in December of 2004, 3 full years before the onset of the financial crisis. And as you can also see, Warren Buffett was already reducing his cash allocation in 2005 and 2006 before the 2008 recession began. This really doesn't make it look like he knew anything about the future of the US economy. In fact, Warren Buffett has never pretended that he had any foresight into economic trends. In fact, he's just simply not a fan of economics as a profession.
I can't recall ever us making an acquisition or turning down one based on macro factors.
So if he doesn't believe in timing the economy or market, how come he is building so much cash today? Well, if you've read Warren Buffett's holy grail investing book, The Intelligent Investor, you'll know that Buffett's current cash allocation actually makes a lot of sense, and it doesn't at all revolve around predicting what the market is going to do next. It does revolve around having more exposure to the stock market when it is cheap and having less exposure to the stock market when it is too expensive. Today, the US stock market is expensive to say the least. The S&P 500 PE ratio, which is a metric that Warren Buffett does pay close attention to, is currently hovering at levels that have only been seen briefly in 2021 and more importantly in 1999 right here, so making the stock market today about as expensive as it's ever been over the last 40 years. But it's not just the S&P 500 as a whole that's expensive today. Pretty much every sector across the economy is at historically expensive levels. This is a chart of the PE ratio of financial stocks or banking stocks that are again about as expensive as they've ever been. The same thing for industrial stocks and for material stocks that have only been this expensive a handful of times over the last 30 years. So almost the entire US stock market is expensive today. Warren Buffett's philosophy is to buy great businesses at cheap prices. So with today's market pricing across pretty much every sector of the economy, he's probably having a difficult time finding interesting opportunities. On the other hand, the yield that you get for holding cash is hovering at around the highest levels of the last 30 years, making it an ideal investment for cautious investors in today's expensive market. In fact, this is also an integral part of the intelligent investor's philosophy. When the yield that you can expect from cash is higher than the yield that you can expect from holding stocks, this book suggests that investors should significantly decrease their allocation to stocks and increase their allocation to cash instead. And today, that's exactly the situation that we are in. This is a chart showing us the spread between the S&P 500's earnings yield and the yield that you get on cash. And today it's hovering at some pretty negative levels. We've only really seen this happen 8 times over the course of the last 60 years, and these are the episodes that you see marked here. And what is fascinating is that when we look at what these moments correspond to on a chart of the US stock market, we see that most of these have corresponded almost perfectly to a significant peak on the S&P 500, and that includes the peak right before the 1987 Black Monday crash. This is simply because a high cash yield versus a stock market yield means that investors are less likely to allocate capital to the stock market and more likely to store away cash and save up. And so this naturally leaves the market more vulnerable to seeing a large drop. So how come we haven't seen a peak in the market yet, despite this spread being negative for the entirety of 2024? Well, that's where we once again come across some similarities between today and the late 1990s. Right here, you had a similar combination of an expensive stock market despite a very attractive yield on cash. And this environment lasted for multiple years. It's only until the 2001 recession happened that the stock market was brought back down to reality, and this set off about a decade of underperformance in US stocks. So a long-term investor who doesn't claim to be able to know what the economy is going to do like Warren Buffett is going to be building cash in this environment regardless of whether a recession is close by or not. But when a decline in the market eventually does come, he'll be deploying that cash back into the market. We don't have quite the same strategy at Bravos Research. We've been riding this bull market throughout the entirety of 2024 with many different trades. Most of the trades that we initiate on our website, we keep for about 1 to 3 months at most. So we don't really need.
So these videos, again, as you can see here in the top right, on the channel on YouTube, Bravos Research, I recommend going and checking out that channel and some of the videos. Obviously, those, as I said, videos contain a lot of eye-opening information. But moving into here, the chart that I wanted to go over. So on top of everything that he spoke about in that video, one thing I do want to point out that I mentioned in one of my past videos when I was going over the SPX and the stock market in general was the United States M2 money supply data, and the fact that there's been a quite significant pullback or drawdown and decrease in that data that hasn't been seen since the 1920s leading into the 30s, obviously coinciding with the Great Depression, relevant to some of the information spoke about in those two videos. So finally here for this chart, one thing I do want to add, and really the main kind of the backbone of what I was going over in my past videos, is what if you look here, so we have the peak of 2000, we have the peak of 2007, we kind of have this mid-peak, this rough mid-range right here in 2014 of this bull run or this upswing, uptrend that the SPX has been on going all the way back to after the 2008 market collapse leading into 2009 all the way up until now. And then we have here this peak back in October of 2021. And I started, again, like I said, making those videos around 2 years ago. So it would have been somewhere right here as the SPX was reaching this local low at around 3.7 thousand points. Ultimately, it did find a bounce along the 50 EMA here, and since then has moved up to right now at around 6,000 points. As he said in that video, we could continue for the reasons he stated and went over. Continue to see the SPX head up here, maybe even up to around 6,500, maybe even a little bit higher by around the end of this year, given we are in December, encroaching upon halfway into this month. Definitely could continue to bleed a little bit higher going into next year as well. But nonetheless, if we also, again, if I zoom out here and go over those points in time that he spoke about in terms of the elections, if we look back here, 1928, 29, as he said, we can see we have this crash here. The RSI gets very oversold down to around 40, 41, 42. Then we look here, 1972, 73, we see this crash here. Also coming down to basically the same area around 40, 41, 42. And then to around 2000 and 2007, leading into 2008 market collapse, we saw a similar crash down to the same level as well in the RSI. Also, one of the things I have been pointing out in past videos is the RSI here. You can see more in the short term right here how the RSI is descending currently. We see this descending currently right now. It appears that there is a descending resistance shaping up right here. If the market continues to go higher here, you could see that end up fizzling out. Perhaps there will be more of a exaggerated bearish divergence that forms here, and we'll see the RSI come up a little bit more and kind of flat line out more so finding resistance horizontally rather than a descending nature. Again, like I said, forming more of an exaggerated bearish divergence rather than full-on bearish divergence. But what's more important is that there's a longer term, more macro bearish divergence that is definitely here and has been here since the peak back in October of 2021, following along with this since 2000, this 7-year trend, each of these horizontal lines where we see a crash ensue shortly after, if not right at the onset of around here, to be precise, around October since 2000. And right now we can see that the RSI is just a tad bit below, coming up to it very soon. Like I said, it could continue to go a little bit higher, could go above this, but I ultimately still think that all of this seems to be shaping up, that there does appear to be in the near future a pretty significant crash for not just the SPX, but even the NASDAQ, really the entirety of the traditional fiat stock market. And one thing that I do want to point out before I get into the flip side of this, to try to play some devil's advocate against those videos and that sentiment, and even my own bias, both of these being bearish biases. One of the things I have pointed out in prior videos was that if we look back here from around 1987 to around 1990, mainly focusing on this entire uptrend right here, we can see around halfway in between it, the price here was having an ascending resistance leading or beginning from around 1987, culminating in around 1994, and from this point onward, the volatility in the price ramped up quite higher than it had been during this prior period right in here. And as I said, so there's an ascending resistance, whereas if you look here at the RSI, there was a descending resistance from 1987 all the way to around 1990. So there was a full-on bearish divergence here, yet the price continued to go up by quite a lot. So we could be potentially seeing something similar. And if we are, and let's say that we're right now where we are currently is very similar to roughly the midpoint of this, as I pointed out, this prior uptrend, we could see the SPX continue to move even higher than was said in those videos I played, perhaps very significantly breaking around 6,500 points, moving up to, if the current uptrend for the SPX that we see here is similar to this past one, and let's say ultimately this would end up basically shaping up like a very long-term, a very macro ABCD pattern, it could move up to anywhere from around 16,000 to 17,000 points. And if it does it in a similar time frame to this prior uptrend, it would fall somewhere around 2034, probably just anywhere within 2030 to 2040 if it does continue to move up here. But again, as I said, that's not personally where I lean to in my bias, and I think there's clearly many viable reasons to not be leaning towards a pretty bullish scenario leading over the throughout the rest of our current decade and into the next decade, to continue to see this go up. But finally, the last thing I want to speak on is if the SPX does indeed see this crash, whether or not it continues to go up a tad bit more, or it is finding its top currently, how far it could potentially retrace, and then segueing that into the fact that all of the past instances, so that 1972, all of the crashes that were spoken about in terms of the presidential elections in those videos, finding similarity to where we are now, not only in the charts, but politically and economically speaking. Something that didn't occur and something that wasn't around during these past crashes was blockchain technology, cryptocurrencies, Bitcoin, so on and so forth. And as again, I've been saying for quite some time, I've been saying since I first started making videos on this topic around 2 years ago, I believe that because of this, it's just further adding fuel to the fire. I believe that we will see blockchain technology take over the traditional fiat stock markets, whereas like clearly as we're looking here at the SPX, this is basically you have a bunch of companies on the SPX, even as the New York Stock Exchange and the NASDAQ, where it's a composite of all of the companies that are listed. And as we see this blockchain technology gaining traction, becoming more and more popular, also you have to think about the decoupling as well. It's very, very much so related to this. And I think once we start to see that decoupling happen more and more, and I think this upcoming crash, assuming that it is going to play out, will really be the major tipping point, will be a major inflection point in seeing the blockchain technology in the market overtake these indices, the SPX, NASDAQ, New York Stock Exchange, and where we will start to see, like, for example, take MicroStrategy and Michael Saylor and what he's been doing and putting Bitcoin in his balance sheet, and he might end up being the first trillionaire in human history. And a lot of other companies, take the Bitcoin ETFs this year have already own more Bitcoin. It's a little over 1.1 million Bitcoin, and it's these ETFs haven't even been out for a full year. That's the BlackRock Bitcoin ETF. That they actually own more Bitcoin now than Satoshi Nakamoto does, which is just absolutely wild to even think that. And again, it's not even been a year. They've also, the Bitcoin ETF for BlackRock has overtaken their gold ETF in literally less than a year. So it's just absolutely astounding. And really because of all of this and this blockchain catalyst, I believe that we will see a lot of these companies slowly start to transition into, their companies will be taken off of these stock market indices, and they will then have a cryptographic placeholder rather than, let's just say, a stock market placeholder. You're buying stock shares for a company, Microsoft, Apple, so on and so forth. Instead, they will then move their ticker symbol over into, for example, let's just say Microsoft decides to implement their company and their ticker symbol using the Ethereum blockchain. And then on the Ethereum blockchain, they have a cryptographic placeholder similar to stocks and the shares that you buy for a company. Because really, the stocks and the shares in and of themselves isn't particularly what holds the fundamental and the intrinsic value. I mean, buying those shares ultimately it's valueless as long as the company, if the company is continuing to maintain and sustain their growth as a business, then that is truly where the value lies. And you're essentially buying a shareholder or a placeholder for the value that the company itself has, rather than what you are literally buying. So, and what this could mean in terms of the crash and how far it could pull back. I mean, if we look back here in 2000, it was around approximately 50%. If we look here 2007 and 2008, again, I mean, it was basically around 50 to 57, 58%. If we go back to 1972, this one was also 50%. If we go back to the Great Depression, this one was 83%. And as I said, as I led into going over this chart, the M2 money supply data for the United States is seeing, or has recently within the last year or so seen, or the last 2 years, I can't remember exactly when I went over that, but has seen a sharp decline that hasn't been seen since the 20s leading into the 30s. And again, like I said, factoring in the blockchain technology and what that could mean in terms of the decoupling and everything else, we could potentially see something very similar to that 80, maybe even more of a crash. So I mean, let's say this moves up to a little bit more, maybe 6,500, and it drops, 50% would put it, let's say 50 to 60% would put it somewhere around like 2,500 to around 3,000 points. Although if it drops, let's say 80%, it's gonna be around 1,200 points. Let's say it starts pushing 90%. I mean, that's gonna be around 700 points. Taking it back here to this sideways range that we could see a rough range of where the support was met in December 2002, and support was met after the 2008 market crash in March of 2009. It would totally break through every single one of these estimated moving averages, even the 800 EMA down here that hasn't, according to this monthly chart, has never even been touched. But assuming that this does end up playing out over the next, few years, obviously, whenever this starts to begin crashing, if it indeed does begin to do so, it's going to take quite a bit of time. I mean, if we look here at this crash, it was in total over pushing 1,000 days. This one here was around 600 days. Back in 72, it was also around like 700 to 800 days. Back during the Great Depression was around also 1,000 days. So I mean, we're looking at around 600 to 1,000 days. So assuming it tops out relatively here soon, let's see here, around 600 is going to put it somewhere around the end of 2026. If it starts pushing 1,000, it would probably find its end somewhere around the beginning of 2028. But as I was saying, if this indeed is the inflection point for the decoupling in the stock markets, traditional fiat markets, really entering their total death stage, and blockchain technology and everything that it is going to accomplish over the next few decades, assuming that it is actually going to take hold of the financial sector, the economic sector. I mean, really, blockchain technology has use case implications far exceeding just like finances and economics. I mean, it has, with all the different projects there are, it has use cases in the political realm, it has use cases in the medical realm. I mean, and video gaming industries, GPU. I mean, just so many things that I could just continue to list off. But overall, just to kind of end this video off, like I said, it could either, clearly at the end of the day, it's either going to continue to go up, it's going to go down, or it's going to go sideways. And really what I was trying to do in this video is to give both sides of the coin. Obviously, I lean towards the bearish side for many reasons, but it could continue to go higher here. As I said, if we see something similar to this prior uptrend, we see that kind of mimic where we see perhaps something like an ABCD-like structure, we could see this. Let's say, as he was speaking about in those videos, that Trump's policies end up actually, for maybe the first time in history, actually negating an upcoming recession, an upcoming significant market crash, and perhaps we will see the SPX, the NASDAQ, so on and so forth, continue their uptrends, and we'll see the SPX somewhere up around 17,000 points, somewhere approximately mid next decade, so around maybe 2035, give or take a few years or so. But all that being said, as always, none of this is meant to be financial advice. But everything gone over and everything said, I hope you all enjoyed, and I hope you all have a wonderful day.